On today's show, 3 questions. Number 1, what was the best investment in 2025? Number 2, why do boomers have less retirement savings than millennials? And number 3, what does dentistry and college football have in common?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to 2 Cents, where we help dentists navigate all the noise. My name is Jake.
I'm Will.
And I'm Rabih.
Yee! Let's get it going, guys. Let's go. We are here. 2 Cents Dream Team. If you listened to the podcast last week, it was me, Will, and Rabih. Matt isn't here again this week. We are letting him have a break. Lauren is joining us on this one. We added a 4th member, so more of a panel here today. Lauren, how you doing?
Oh, fantastic. It's freezing cold outside. Wishing that
Anyone-
I was going to Disney like you.
Anyone listening with their headphones on just got a yee-hee in the ears. Well, good morning if you're listening in the morning.
Good morning if you're listening to this as this publishes on Saturday. I am going to Disney next week. You are right. I am a middle-aged white guy who lives in Utah taking his family to Disney. That's what I'm doing next week. Stoked about it. We're going to have a really good time. Anything else we need to hit on, guys, before we jump into our topics here, our questions?
Yeah, this is a pre-recorded podcast, right? So
This is pre-recorded, a little peek behind the scenes because of my Disney trip. We are recording this after our last one, week before. Still going to be great. We're still delivering the goods to you guys. Okay, so let's do this. Let's start with our first question. Let's jump into it, Rabih. You don't really like this question, but what is the best investment? What was the best investment in 2025?
what would you guys guess? Let's start with that.
Lauren?
I don't know. I'm always so bad at this. Pick somebody else.
I would guess U.S. stocks, but that's just because that's an easy low-hanging fruit. But I know that's not the answer.
Yeah. It was not the answer.
Gold.
Well, let me
been
give you
crushing.
some hints. Let us walk. And I love that I have the 3 of you with here on the call today, because you guys have gotten, client calls, and I'm sure at each month there was a certain worry for your clients, right? Asking you about what's happening. But if we take a summary, right, of this year, we had, a new president at the beginning of this year, and then we had some recession fears early in the year. After that, we had a Liberation Day where, tariffs were thrown on all countries, and then tariff deals started showing up one by one. After that, we had historic S&P 500 run, like 30%, 35% in a couple of weeks. We got a big spending bill, the largest ever created. We got tax on a foreign country in Iran, removing their nuclear warheads. We had the longest government shutdown ever recorded on history this year. We had
This is all 2025, just 1 year.
All
You're
of
not
that
talking about the past
2025.
decade. Okay.
We
good to know.
had fears of an AI bubble bursting because tech companies were investing in each other. With all of that happening, what would you think made money? The answer is everything.
Nothing. I guess you could argue that nothing.
Nothing.
Yeah.
It's so interesting you said nothing, because it was all
Trick
across the
question.
board. But everything made money last year. Like gold was up, houses were up, stock market was up, bonds were up, etc. So just to give you some
Pokemon cards are up.
Labubus are up. Al showed up last
The
year.
Utah Jazz down. The only thing down, the Utah Jazz. Everything else was good.
Yeah, do we want to go there? So to just give you some returns,
No.
The most returning asset class, or if it's not really an asset class, but a commodity, was silver with like 144%, followed by gold at 63%. And then the third was developed market stocks at 35%, 34%, and then emerging market stocks at 31%. Followed by a globally diversified portfolio at 22% for the year, a big win, big year. The S&P 500 got 17%, long-term US bonds 4%, Bitcoin was down 7.5% for the year, and oil was down 20% for the year. Also, US dollar was down like 20% for the year. So these are how our asset classes rank. And given what we've heard, I really like Jake's intuition. We would have thought that nothing made money. but everything did. I wonder what were the main concerns on your client's mind, especially now that we're looking in hindsight, and hindsight is 2020.
Will, do you want to start? Do you have any things clients were saying over the past year? Not really.
I mean, no, because it sort of felt like business as usual in a way. Like I had a handful of clients reach out in April on Liberation Day when Trump, that's
the big thing that comes to
that
mind
was
for
the
me.
big like stock market, situation during the year, and it felt like I had a bunch of clients able to put more money in at that point, which is pretty awesome and speaks to young investors. It's always super counterintuitive, and I always preach this to my clients, but as young investors, you should actually want the market to kind of do poorly. Like, it's fun to see all the green arrows, but as a person who is putting money into the market, you get a better deal if it's down.
Just giving you some buying opportunities at lower prices, is
Right.
is what you're saying there.
Right.
Yeah, what's interesting, that was the same thing with my clients. Is I know the Liberation Day tariff thing back in April was a big deal. People were scared. It was short-lived though, right? It was really just a couple of days, and the market rebounded pretty quickly after that. And it's been strong ever since. One thing I wanted to bring up, Rabih, I don't know if you're getting to this, which is emerging markets, international stocks performed really, really well last year. We've talked about this a little bit. Did you know that 2025 was the first year that emerging markets and developed markets both beat the S&P 500 since 2017? So it's been about 8 years.
True.
Since both of those categories were over the S&P large cap stocks, which I think we've seen international making a bit of a comeback here in recent years. I just thought that was noteworthy of like international comeback was a big, I think, stock market story in 2025, with both of those categories almost doubling up the S&P 500, which is not insignificant.
It definitely is not insignificant. And I really like that the client feedback was not panicky, because these numbers that I just showed you guys are assuming you bought on the market on January 5th, 2025, and you did not sell or did not touch your portfolio until December 31st, 2025. However, throughout the year, it could have gone in all sorts of ways. If we look at drawdown for a bunch of these asset classes, most of them, yes, dropped around Liberation Day, excluding oil and Bitcoin. But for example, for tech, we had a 30% drawdown back in April from the high. Gold dropped only around 10% around November. The S&P 500 dropped 20% on Liberation Day, etc. Oil is currently 28% below its high. Bitcoin is down 30% from its high. Had you chose to purchase, at Liberation Day and do nothing and panic and sell at the bottom, this was not one of these years where you're slowly climbing up the ladder of returns. There were swings, and timing could have ruined your portfolio. It could have easily been a year where you lost 30% on your portfolio rather than being up 30%. So I think, I know I'm being cheesy here, but you guys do not get credit enough. But I think the best asset class was, the clients who listened to their advisor's advice to stick throughout and hold for the long period, or else it could have been a completely different scenario. The market could go in one direction, but people could have completely different experiences around that direction when timing is included, when fear is included, etc. So that is 2025 for you guys, and hopefully 2026 is smooth sailing.
We'll see. TBD. I had a client, interesting on that point, Rabih, which I like to just kind of highlight that. I mean, not to toot our own horns or anything, but I had a client reach out to me during the week it was the Wednesday when the market dropped. I don't know, it felt like 10% that day, the day of the tweet. And a client called me and he said, I have one of my staff members' dads is a financial advisor and I'm on his email list. And they sent an email this morning saying that they recommend all their clients move to cash. And so he's calling me. He's like, "Hey, these guys are legit. They're a big advisory firm, and they're having all their clients move to cash to wait out to see what happens with the tariff situation." And I just go, my response is just along the lines of, that to me, that's the worst thing you could do in a moment like this, because Trump could tweet tomorrow and all of this gets resolved. And again, I didn't even know that was going to happen, but you can't time the bottom, and you definitely can't time when it's going to go back up. And so he told me months later, he's like, "I'm really glad I didn't sell at that point." I talked to this guy and he says they're still dealing with the repercussions of that move.
Oof. That's sad.
So, I mean, it's tough, but again, it's just another notch in the cap for stay in your seat. There's going to be turbulence. Don't get up and run to the bathroom while there's turbulence. Like just hang out and you're going to be okay in the long run.
We really do not know anything about the stock market except very, very few little points. And these few points are big moves follow big moves. So big moves to the downside follow big moves to the upside. So when you're panicking on the worst days, you might be missing out on the best days if you sell. The other thing that we know is that staying in the market for the long run rewards investors because on the long run, all this noise goes away. And what remains is, every single person in this country going to their work, trying to make a better life for themselves and for their loved ones, which translate for a benefit of everyone, higher stock prices, better products, better quality of living. So just really adopting a long-term perspective allows you to lock in these really good returns that we saw this year, regardless of how much the market fluctuates throughout.
Awesome. Lauren, anything you wanted to add here before we move on? Things top of mind for you?
No, I love it.
Okay. Yeah, I agree with that, Rabih. It's interesting. Like year to year, we have really no idea what these asset classes are going to do, right? Like commodities could be top one year and then bottom next year, and there's going to be a lot of fluctuation. Long-term, things get more consistent. That discrepancy, I think, highlights a pretty key investment lesson that you mentioned there. One thing before we move on to our next topic, it's hilarious that I was thinking we're taking a quick tangent here, break from financial talk. Did you guys notice that I said so-and-so returns were not insignificant? So like, in other words, I could have just said significant instead of not insignificant. Isn't that funny? Like people say this all the time. It's like, it's not uncommon.
Yeah.
So it's common then, is what you're saying. English. Anyway, I thought that was funny. Okay, let's get to our second question. Lauren, we're going to turn some of this time over to you. The question is, why do boomers have less retirement savings than millennials? Is this true?
I guess it would be more of like not necessarily less retirement amount, like retirement savings, but more about
like savings rates.
Yeah, more about
Okay.
a little bit of both. So I read this article that I thought was super interesting because I feel like as a group of millennials, I think all of us are millennials. I really don't know the difference between them. Do you guys know like what makes a boomer versus what makes a Gen X versus a millennial?
Or... boomers are ahead of us, right? So it goes boomer, Gen X, and millennial. We're all millennials, I'm pretty sure.
Our parents or our grandparents? It'd be parents, right? My parents are boomers.
Our parents are boomers, yes.
Okay. What are grandparents? They're just old.
Greatest generation?
Oh.
Silent generation?
The silent generation.
Silent?
Yeah.
Okay, well, that's interesting that you said silent generation because one of the reasons on here was that boomers didn't grow up in a household where they could talk about finance, but yet millennials did. So
do we? Do millennials still grow up in, I don't know.
Like our parents were more willing to discuss finances and money way more than the generation before them. So like their parents.
Probably.
So I thought that was interesting because one of the reasons, I mean, I guess it's kind of a smaller reason, but it was that they had less financial education than what we pushed in our own like youth and in our lives, which I still think is not very much. I don't know if they teach finances in school. I guess somebody else will have to tell me if we're out here, but
I think they do. I just think with all of the teaching kids finance, like trying to tell a 14-year-old finance stuff, he's like, I don't care. Can I play basketball? Tonight, that's really what I'm focusing on. Anyway.
But that was one of the reasons. Another one was the switch from pensions to 401ks, which I think is really interesting too, because with pensions, I feel like I never see these. You guys probably see them way more than I do, but with pensions, you didn't have to necessarily contribute to them. There was
no saving for retirement. You just had a pension.
Your company saved for you, essentially. They took a percentage of your pay, whatever, and they put it into a pension for
you. And then they also decided what investments you'd be in. So it's like you didn't really have to pick anything, and you just kind of showed up one day on day one, and you're like, cool, I get, looped into this pension plan. But boomers stepped into the workforce when pensions were going away and 401ks were being introduced. And so they had to choose to opt in to the 401k as well as pick their investments and choose like the right investments for them based on their age and their risk tolerance and stuff like that. Versus pension plans, it's like they just had to be like, well, cool, I get this guaranteed amount for the rest of my life, right? Like it never runs out. They get it forever, no matter how long they live.
Yeah, I mean, to that point, it wasn't like 401ks, retirement plans, all these plans are like a fairly new thing, obviously. Yeah. And like a Roth IRA has been around how long? Like 15 years?
I used to know the exact date. It's either late 1990s or early 2000s. I can't remember.
With that said, like 20 years, let's just say. So it's like it is a relatively newer thing. Like these savings vehicles are now available, and they weren't even available when boomers were starting to save for retirement. They weren't available to even use. You couldn't have a Roth IRA at that point, which is interesting.
Yeah. Another reason that I thought it was sad was the Great Recession. Because again, they were like in the middle of their most powerful earning years, and they got hit with a recession. I mean, for some people it was fine. Like for my parents specifically, it was like awful. Like my parents had the whole foreclosure, lost the cars, lost the house. Cause I grew up in Vegas too, which I think Vegas, what movie is that? The Big Short.
Yep.
Yeah.
Where they talk about the experience Vegas had, but it was so true. And like all of a sudden, like neighborhoods were just empty, and your neighbor of like 10 years is like gone out of nowhere. And so anyways, I thought that was interesting too, that like in their most powerful saving and earning years, they were kind of just stagnant.
I want to speak to that for a little bit, if that's okay, because I hear this often too. I think that's a valid point. But I hear a lot of stories and anecdotes of people saying, yeah, either me, myself, or my parents, or a friend or family member, whoever, got wiped out in 2008. And that's like a common thing, and it's always wiped out. Is kind of the term that they use.
I would
So-
exactly how I would describe it for at least my own parents.
yeah, but I just find it's like, for me, I think it's like that phrasing, the actual words wiped out is what they always use. Is funny to me. Like, hey, I got wiped out in 2008, which I think highlights, or we can talk to teach a bit about investing there, which is if you're saying you got wiped out in 2008, what was our max drawdown there? We can probably pull this up. 35% or so?
50.
But was it more? Got down to 50? Okay, so 50.
Yeah, I think the intra-year drawdown was 50.
Sure. Yeah, intra-year drawdown 50. I think the year finished about 30% or something, right? Kind of like calendar year ending there. Anyway, so it's like, okay, you had a 50% max drawdown, which is like that wiping out half of your funds. That hurts. But again, this is like when we have to distinguish between what actually counts as a loss. So it's like, okay, if you lost all of your money in 2008, does that mean that you sold at the bottom? Like, did you take the 50% hit and then cash out of everything there? You didn't hold on to let your stocks recover at all? That's like the first question I'm asking. Like, did you just decide to get out at the exact wrong point? If you did, probably some bad investment education.
Most of the people did it. For sure, from my parents, I like vividly remember them asking themselves to like withdraw everything in their retirement plans.
Yeah. Crazy. So,
okay. Like, had they not done that, they probably would have been like way better off. So exactly like what you were saying too, like, you know, sit down. What did you say? Not go to the bathroom in the
don't get up when there's turbulence.
Yeah.
That's like a big investment principle. You actually don't lose anything until you sell. Right, that's like a big investment principle.
50% feels like a nosedive, so you have to like tighten up your seatbelt and put the mask on for sure.
You're gonna have to put the mask on.
I feel the same. So like I remember a call with like a prospect once where they were like, yeah, I just don't trust the stock market. I just will never invest in the stock market. I was like, okay. And they were like, yeah, my parents were on the verge the year before they were supposed to retire, and yeah, wiped out, whatever, lost everything in the 08-09 crash. And in my mind, I'm thinking, why would anyone who's on the verge of retirement be exposed to 100% equities?
My second point, Will, you read my mind. Okay.
Like if you're going to retire next year, then your asset allocation should be a lot more conservative to where you're in assets that don't draw down 50%. And so for me, that yes, it's a good point. But I think to Jake's point that, you know, we need to have better education and accountability to where a drawdown like this shouldn't, I mean, yes, it should. Frankly, a lot of people should have gotten rich. They should have been putting more money in at that point. I know it sounds cliche, but in hindsight, it's like that was the investment opportunity of a century, was to buy real estate and stocks during 08-09. And you would, you know, there's people that did that and made it a killing. So,
but yeah, to the people who are retiring, like you mentioned, is you should be in a more conservative portfolio at that point. Hopefully, again, I know this is like, in hindsight, it's easy to say, but as you're planning for retirement, don't expose yourself to all equities. Also, you hope, like planning wise, you're holding a little more cash if you're getting to more of your twilight years, looking to retire, more cash on hand. That hopefully helps you stay in your seat. Or like, I'm holding more cash, so I don't have to freak out too much. I don't need to use these assets, and I can live off those. Yeah, that's just some good. I'm glad you brought that up, Will. Just planning points I want to hit on. Sorry, Lauren. Okay, go to your next one there.
I only have kind of there's 5 of them, but the last one is the auto enrollment. What is it called? QACA? I don't exactly remember what it stands for. Qualified
Automatic contribution, something arrangement.
For
Which I
401k plans or retirement plans.
Yeah.
Which I feel like when we're creating 401k plans, I mean, like, are we hitting that like almost every time we kind of create them? Like, I feel like for the most part,
It's currently like the legislation that is currently going to become mandatory to have an automatic enrollment plan going forward.
Because in the past, it's like, again, you were kind of automatically into the pension. It's like you really didn't have to think about it. But for us, a lot of people who like joining the workforce or in the workforce and get new jobs, like they have to automatically be enrolled without doing anything. And I feel like for business owners, it's kind of like, oh, that's so annoying. But again, for like people who are trying to retire and millennials as a whole, we really are, I guess, better off than than maybe we think. Because I think it had specific numbers too of like the retirement balances that boomers have versus millennials.
That's what I want to ask, Lauren. Like, as you're looking this up, because my mind is like, okay, do boomers have more, less savings than millennials? It feels impossible to me that millennials would have more. But I wonder, are they doing like same age, like millennials at this same time frame? Are they
at that point when they
at
were
that point? Like, is that what they're showing there?
No, they're just showing. Oh, I'll tell you the numbers. So the average 401k balance for the different generations as of quarter 2 of 2024, the average 401k balance for each generation for boomers, it was $242,200. For Gen X, it's $182,100. For millennials, it's 62,000, and then Gen Z is 12,000.
Okay, so balances are less.
Yeah, so our overall retirement amount is less. But what they're saying is when you hit their age, we will have significantly more than they do. Which
I believe it.
Interesting.
And even on an inflation adjusted basis, my guess would be that's true. Yeah, I think sometimes, there's plenty of things that millennials have to complain about, sure. And we talk about those all the time on this podcast and on our other podcasts. I do think we live in probably the best time to do personal finance and to save and invest money. You talked about the auto enrollment is awesome, and there's advantages to the accessible accounts that we can use and Robinhood and all these easy things on your phone, and you can just invest with the click of a button. And it's never been easier to put money away and save for retirement. I don't think that it ever has been. So I think that's a crucial point. Rabih's been sitting here in silence. Do you have anything, Rabih?
No,
that you
I
wanted to
like
talk
all
about
what
on
you
this?
guys are talking about, and it actually makes sense that the retirement life of millennials is going to be better than the boomers, just because the economic life of millennials is better than that of boomers. If we look at the economy and how much we have GDP per capita, how much output each one of us is allocated from the economy, how much productive the younger people are compared to the older people, this has to translate to more money because it's more value. So it all makes sense for people who feel that they are not, their feelings don't align with this data. It's probably a specific case scenario rather than the overall trend we see between each generation.
Very good.
I feel like a really overarching thing, and then we can move on to the next topic, but I feel like every generation has its hard thing. Like millennials, it might not be retirement, but it was houses. Or, it says on here, Gen X has the most credit card debt than any generation. So it's like for Gen X, they had their own struggles, So anyways, I just feel like every generation's going to have something. And it's better to just do what you can do and focus on what you can control than just be like, oh, my parents are so better off than I am. Or like, these old people that bought all their houses and,
Yeah, I like that. We can't buy a house, but we didn't have to go to Vietnam. Is that worth the trade-off? I don't know. We can think about that there. Okay, good. Let's hit to our third question here, William. What does dentistry and college football have in common?
Yeah, this is close to home. This one's going to hit hard for us.
Because we love dentistry and we love college football.
Because we love dentistry and we love college football. And even in more unique fashion, this is regarding my personal alma mater and Rabih's technically alma mater, right? Yep. And the University of Utah Utes, our football team, our beloved football team here in Utah.
You're our guy. Yep.
Yeah. So this happened at the end of December, so it's not breaking news, but Utah made a deal. University of Utah made a deal with a group out of New York called Otro Capital. I guess I'll back up. What dentists and college football have in common is that PE has arrived. And PE, by PE, I mean private equity. So in dentistry, of course, private equity is DSOs, roll-ups, these outside money that's getting involved to put together group practices and commercialize, commoditize, use dentistry as a consolidation tool to make money. And dental practices are really efficient little businesses that they're going to group together and try to sell for big dollars. So that's private equity in dentistry. Private equity in football is interesting because it's never been done before. So this group invested, Otro Capital out of New York is investing $400 million into the University of Utah's athletic department in hopes to make money, right? Like that's the role of private equity. Anytime private equity gets involved, they don't care about anything but making money. So college sports, we're in this kind of new era of the commercialization of college sports. There's players that are getting paid more than they've ever gotten before. Coaches getting paid more than they've ever been before. Revenue. Do you think revenue is a problem in college football, Jake?
Overall, no. Here's like the whole thing. If we want to dive into college athletics, is football is king, right? The same with kind of like NFL in America. The whole athletic department survives off of the revenue that football brings in. Essentially, like football is the only income producing sport, and then the rest just live off of the profits. But most athletic departments too, I think this happened to the Utes, actually have like they're underwater year by year. Like they're
losing money. Most are losing money
every
because
year.
Football brings in the most revenue, basketball brings in the most revenue, all the other sports actually lose money. And so the overall like University of Utah athletic department lost money last year. It's not really a revenue problem for football, but it is a spending problem, is what like people are saying, is the costs of all these things have risen. And revenue's risen, but it's not keeping up with costs, which I think maybe some dentists can relate with that, where like your top line is not keeping up with the rising costs of things. And what is private equity going to do? They're going to come in and cut costs. Does this mean the marching band goes away? Because I think the marching band costs money, right? Like, is this?
Don't you dare.
You know what I mean? Like, is this that Olympic sports get cut? Like, do we start at some point? They got to start cutting stuff, and so it's going to be really interesting to see what this play is. Does it mean good things for the football program, but bad things for the rest of it? I liked this quote. So, like, Utah was the one the president's on record saying like, yes, this is a risk, but he said. It's a risk in not doing it in a way. Like we're either going to do this and get ahead or do it and not do it and fall behind. But it's kind of a coin flip in a way. And then it's interesting because let's see, there was one that said even the mighty and massive Ohio State, which brought in $254 million of revenue in 2024, ran a $37 million deficit while operating 32 athletic programs. So that's kind of your point. It's one reason why Ohio State supported a $2.4 billion private capital deal between the Big Ten and UC investments before the proposal stalled out last month because of opposition from Michigan and USC. Mark Bernstein, chair of Michigan's Board of Regents, aptly noted that until runaway spending was addressed, the deal was simply akin to a payday loan, which I thought was fascinating. Like they're comparing these private equity deals to a payday loan, which is essentially just like, let's get a big infusion of cash to like try to fix our problems. But fast forward 3-4 years and we're probably going to be dealing with the repercussions. And that's what a payday loan is, right? It's like fix the problems now, and in the future we may have to deal with the issues, which I guess to relate it back to dentistry is private equity. In a way, we've seen this happen with a lot of our clients where in a way a lot of people sold to private equity thinking maybe not a payday loan, but it was like, oh, private equity is going to come in, they're going to solve all my problems, they'll take all this work off my plate, and I'm going to be in a better position in the future. However, a lot of private equity groups were not able to deliver on that, and they consolidated a bunch of dental practices, and now the dentists are the ones left holding the bag. So I don't know what that means for college football, but I'd like to get your guys' thoughts.
I want to get Lauren's thoughts on this because I know she's absolutely thrilled that we're talking about football and sports. She's just we just got to get her insight in this. But before that, it's actually, this is hard for me to talk about objectively, honestly, because as a fan, I love the University of Utah football team. I'm just thrilled. So listen, they did this PE deal. I'm generally not a fan of private equity, and we can talk about all of that. Do I want it to work out for my sports team? Yes. I don't want to say the Utes made a bad decision by doing this.
But do you want it to work? Do you want private equity to work out for all your clients? Yes, you obviously do, right?
Yeah.
Like it's tough because you put a lot of eggs in a basket that you don't know what's going to happen.
Yes, I hope it works out well for my Utes. We can get into a whole DSO conversation here. We talk about this all the time, and this, we can speak to it of I like that idea of a lot of times we see dentists looking to sell to a DSO, whatever point in their career. Yes, like number one, usually is because of the dollar signs, right? That they're looking to sell to is just, oh, can I get more of a payout for my practice that I've worked so hard to build? I think the second reason, Will, is like you mentioned, a lot of it is I am stressed. I am burnt out. I can't find an associate to work in my practice. I do not want to deal with people anymore. The management issues are crazy. I feel like my practice is declining. I just need a fix right now. I can't survive. And I want to do this. And I'll deal with some of the repercussions later, which again, I think that's exactly what's happening in college football. We'll see. I guess with all of this, right? Private equity and dentistry, private equity and college football, we'll see what happens. Lauren, Rabih.
Why did I think that was illegal in college football? Like, I feel like there was something where some sort of college got paid to do something and got in trouble. This is as far as I know. With
there we go. Lauren's bringing in NIL stuff. I think you're talking about NIL, like paying players used to be illegal back in the day. You could not pay college kids to play for your university. You can now.
But
and
again,
it's opened up a whole can of worms.
It is kind of the Wild West, like with a lot of this stuff, and it's akin to dentists, like DSOs entering the dental space. It was kind of the Wild West, like. There were crazy valuations and
still
people that, there still are, but it's an interesting, maybe there's some legislation down the roads that block this. I have no idea, but we're going to see what happens.
Rabih, you're pro private equity. You love what's your take here?
What I'm having trouble with is that private equity in this college context is completely different than private equity in dentistry. They are the same type of. It's a completely different business model. I'm not informed enough on how they would execute that business model in a college, football environment. But we know in dentistry that
we don't know.
We know in dentistry that they come over and they are probably using the same secret formula to prop up a couple of different dental offices at the same time, and they're trying to extract value through efficiency, through synergies, etc., where they can bring that dental practice to operate at the forefront of what the best it could be in their neighborhood, in the area that it works. With college teams, well, isn't it a pretty efficient, fierce competition where you need to be already running a well-run ship? Like, where are the synergies with them coming in? I do not understand. And this is because private equity itself is changing a lot. This is inventive. We'll see where it goes. And hopefully that may or may not influence the old school private equity deals that we know of in dentistry, in leverage buyouts, and wherever, all the other places we see private equity.
Yeah. Lauren, sorry, I think we cut you off. Did you have a question you wanted to ask or anything there?
No. Is this like a Ted Lasso? Like, is the University of Utah the first person that's like it's giving Ted Lasso in my head, and maybe that's not how it works, but I'm like, I'm seeing like football club. I'm seeing like
they are the first. Yeah.
Of the, the ownerships is this University of Utah is the first to ever do this. Maybe it's a good thing. I don't know.
Yeah. I don't know. As long as it gets them a championship, I don't,
like whatever.
Let's win football games and let's deal with the consequences later.
I think
football doesn't see that coming. Football may be the most boring thing to watch, probably ever.
Lauren coming off the top rope with that take. Football is the most boring thing to watch. What were you saying, Will?
I was just gonna say, just to kind of tie a bow on this, football is amazing. But to tie a bow on this, anytime private equity is introduced, whether it's good or bad, this is not an indictment or take on private equity, although we have those takes. Private equity is driven by one thing, and that's profits. And so sometimes the people are the ones left to deal with the repercussions or the decisions that private equity will eventually make, because they don't have emotions. They just see numbers. All they see is, what's going to give them the best ROI on their investment. In the context of dental practices, maybe the patients end up suffering. Maybe your staff ends up suffering if you go with a DSO that doesn't treat your staff right or doesn't take care of you, or, there are a lot of things that will happen. But at the end of the day, money, cash rules everything around me. Cream.
There we go. Yep.
And so, I mean, it's going to be interesting to see play out. I don't know. I mean, obviously there's no real parallels to dentistry other than that it's private equity getting into the space. But for dentists, we always say, make sure that you really, really, really think long and hard about any type of private equity deal that you're going to take, and get an advisor involved to make sure it's the right fit for you, your time, your career timeline, the offer you're getting, the eggs you're going to put in the private equity basket, all those things. So.
Love it. Okay, very good. Those were our questions today. Any other closing thoughts that you guys have about anything? Lauren, football's boring. What sport do you like to watch
I would say
over football?
I'd rather watch. You guys are going to throw stones at me. I feel it in my bones. I like baseball. I would rather watch baseball than I would watch football. Baseball is such a vibe. I'm like, you've got your Cracker Jacks and your hot dogs.
Okay.
And football is just like, so I never know where the ball is. And like baseball, you follow it around a square, and it's just, where it's at and you follow it.
Lauren, I guarantee there are people listening to this who agree with you. There are probably people out there like, yeah, football sucks.
Does Dancing with the Stars count as a sport?
It does. And football, it doesn't make any sense. I don't get when football goes. Like at what days? I'm like, it's like November and I thought that was Super Bowl. It's not. It's like in February. But like, why is football so important freaking on Thanksgiving? I'm over here thinking Super Bowl is like, oh, clearly it's because Thanksgiving, Super Bowl is like right at the same time. And all of a sudden, I'm getting told that Super Bowl is today in February. I just didn't see it coming.
It is every February, Lauren, the second week of February every single year. So you can bank on it there. So now moving forward, that's when the Super Bowl is. This is why we needed you here, Lauren, for this take. Sometimes we get way too football heavy. You could be like, you guys are dumb. Football sucks, which is what we needed.
It's good.
Yeah. Okay. To all of our listeners out there, we do want to plug our Dentist Money Launchpad course that we are introducing February 6th. This is essentially an education course for D4s or dentists who are just graduating who want to get kickstarted in their financial journey. We essentially want to give you all the information that you should have learned in school of how to manage your financial life. Again, as I mentioned, it starts February 6th. There are 12 weeks of 12 courses, different things to learn. All 4 of us here are going to be giving presentations and teaching there. We're excited about this. Tell your friends about it, anyone who's interested. We think this is going to be a really cool thing. If you want to register, you go to dentistadvisors.com/launchpad and you can register. It's going to be a cool deal. We're excited about it. Okay, let's end it there. We'll let you get to your weekend here. Thank you, Lauren. Thank you, Rabih. Thank you, Will. That was our 2 cents. We will talk to you all next week.